slide through this. Good morning, good afternoon, good evening, everyone, depending on where you are. Greetings and assalamu alaikum. My name is Parker Winfall. I'm going to be your moderator for today. I'm an advisor to Taqiim on valuation matters, and I will be moderating the session today, in addition to my fellow presenter, who's Jim Gavin. Some general points ahead of the presentation. There's an embedded translation button in Zoom, which is an option. So you can basically choose to listen along in Arabic or listen along in English. Today's webinar, in terms of the questions and answers, we'll generally leave the questions to the end so that it doesn't interrupt the flow of the presentation. But if there are pertinent questions which tie in directly to the topic of the presentation or the slide we happen to be on, I might interject and ask that question so Jim can elaborate on that. Today's webinar aims to, among other things, address international best practice in the financial reporting valuation process within the context of IFRS as applicable to the customized Saudi IFRS. The webinar will highlight some of the differences between market value and fair value premises in their application. Also, we'll explore some of the challenges with implementing the valuation methodologies and how they address these and how to address these challenges. For our speaker, I'm honored to introduce our speaker for this evening. His name is Mr. James Gavin. Jim is a former colleague of mine and was also my managing director at Kroll, formerly Duff & Phelps. I work closely with Jim in his capacity as vice chairman of the IVSE Tangible Assets Board, one of the boards which collectively constitutes the IVSE Standards Board. Jim Gavin is a managing director in the San Francisco office of Kroll, and he's part of Kroll's real estate advisory group. He's the practice leader for real estate services on the West Coast, specializing in consulting and valuation engagements. Jim has 40 years of experience in the real estate industry, having worked throughout the United States and internationally, including in South America, Europe, Asia, and the Middle East. Jim's Middle East work includes a complex project I worked on with him in the GCC for a national oil company. Jim received his undergraduate degree with an emphasis in real estate and urban economics from the University of Wisconsin. He's a member of the Appraisal Institute, a counselor of real estate, and a fellow of the Royal Institution of Chartered Surveyors. Currently, Jim is the vice chairman of the Tangible Assets Board for the International Valuation Standards Council. Thank you for your invaluable contribution to Taqeem's continuous professional education series, Jim. At this stage, I'll hand over to you.
Okay, great. Thank you, Paco. Let me take care of the, get myself the presentation together here. Bear with me a second. Great. Hopefully, Paco, that's viewable for everybody.
Yes, it is. Yes.
Great. So, yeah, as Paco indicated, my name is James Gavin. I work for an organization called Kroll. What I wanted to first provide a disclaimer here, and again, what you're going to hear this evening, and I appreciate everybody taking the time this evening to join us. What you're going to hear is really my views, my experience, my opinions. It comes with, as Paco indicated, 40 years of experience, but along the way you make decisions or come to some conclusions around different avenues of valuation and understanding of standards and application of standards through that experience. So clearly, this is my views, my opinion as someone who's been in the business for 40 years. Also as a vice chairman of the IVSC, my takeaway from the Tangible Assets Board. So I wanted to make sure that was clear, and would appreciate in terms of reproduction that I have no issue with sharing this with people internally within your offices. I just don't want it rebroadcast or republished in any way without my prior consent. In terms of Kroll, I just want to give you a little bit of background. From a real estate perspective, we cover different, as Paco indicated, I have had quite a bit of experience worldwide, and so we have offices worldwide. However, not all real estate related offices. So the offices you see here don't necessarily reflect real estate presence. However, we have capable people in these offices where we do deal with referrals in those markets relative to real estate, along with other types of consulting assignments. Kroll is a broad-based business, also within forensic accounting and cybersecurity and things of that nature. So I would encourage anybody to learn more about Kroll to go to kroll.com to hear more about Kroll. We do have a presence in the Middle East, a growing presence in the Middle East, and happy to be very active there now. You've been through this. Paco took the time to go through this, so I'll move on to that. Through that, what I wanted to highlight here was just simply, as an organization, we're very committed to being part of different other appropriate boards and standards that are available worldwide. And you'll see here the IVSC being a prominent one. Again, yeah, I think what you're going to hear today will be heavily focused on IVSC related and international accounting standards, IAS. Okay. So why do we need proper valuations for financial reporting? I think this is, Paco took some time with me to kind of talk through the kind of things he wanted highlighted in these discussions. I know you've been through some previous presentations, so I want to do maybe a little bit of a refresher on this and essentially the process of international accounting standards is really under financial reporting standards of IFRS. So if any organization, if you're working with a client that has broad coverage worldwide, generally speaking, you're going to find that they're reporting their accounting standards under IFRS. This and again, this means IFRS 13, which again, I think in previous presentations that's been discussed and outlines the methods and considerations that a valuer and appraiser should take in performing evaluation for financial reporting. What is the financial reporting? We'll get into that again in terms of the basis for that. But in essence, IFRS, it has to do with appraisal standards dealing with accounting standards. Some markets, have different paths. I know in Saudi, you focus on through Taqiim, the customized Saudi IFRS. I would guess that most of you on the call deal in that. If you're doing work for financial reporting, would deal in that realm. I reference a couple other sources here, parts of my experience under the Appraisal Institute and USPAP, which is a U.S.-based standards, or the Red Book, which is a RIC standard in the UK, but has a broader context in Europe. The point here is that really ultimately you want to be following standards that are applicable, to the market you're working in, and you should focus on those particular standards. What I have found through my experience with IVS is that, frankly, at the end of the day, there's not a huge differential. There may be certain types of aspects in local markets that are important that you need to follow, whether it has to do with the requirement for inspections or the requirement for certain elements being disclosed in the report. But for the most part, the processes we go through from a valuation perspective aren't different really anywhere in the world from that perspective of the considerations of the different approaches to value. Generally, for financial reporting, you're working with public companies for the most part. They've got the responsibility to set the values of these assets on their books and balance sheets at fair value. Fair value, very critical to understand why fair value. There's many different definitions of value, but in this case, we'll be talking about fair value. Private companies, and again, I'm not, in Saudi, I'm not quite sure how much this would be impacted, but we were finding in other parts of the world that companies that are not publicly traded, are on the stock exchange of any kind, are adopting more methodologies or more best practices around similar reporting that public companies do. So the reason they're doing that too, there's a greater need for transparency in the markets today. A lot of investors want to see even best practices, even though there may not be a requirement for a private company to report under IFRS standards. Investors are demanding it. So, and also it's a good thing from an exit perspective when if a company does get acquired by a public company or is looking to be sold, having these kind of processes in place is a very important thing to have in place, just from a best practices standpoint. So again, we're going to be focusing on fair value for financial reporting. To finish up on the refresher side of things, fair value, again, under IFRS 13, which defines fair value, is the asset with the price that would be received to sell the asset in an orderly transaction between market participants at the measurement date, which is the exit price. If more than one market exists, then attempts should be made to identify the principal market. My takeaway on this, and this is again essentially how I distinguish between fair value and market value. When I look at this definition, when I see the words orderly transaction between market participants, what that tells me is that we're talking about participants in the same type of business, the same type of corporate entity to some degree in terms of how they conduct their business, but the kind of business that they're executing. In my mind, that is more of a value, I would think, in use or continued use of the same business. The comment here, the last sentence, if more than one market exists, then attempts should be made to identify the principal market. Again, that kind of rolls back to, okay, I've got an industrial facility that could be used for a broader context for various different uses, but I have a very specific use of that industrial facility. And I need to look at similar users where on a turnkey basis, in my mind, on a turnkey basis, would we be jumping into the same use versus a market value. When I think about market value, this is the IVSC definition, the estimated amount for which an asset or liability should exchange on the valuation date between a willing buyer and willing seller in an arm's length transaction after proper marketing and where the parties each acted knowledgeably, prudently, and without compulsion. This, to me, is a broader context in terms of the broader definition, meaning that I think of this more of a value in exchange concept. And what I mean by value in exchange is that you open up the broader market, that same industrial property that you appraise under fair value. In the case of market value, there may be a highest and best use issue around this property, whereby the current user may be underutilizing the location, or may be may have developed a super adequacy on that location that from a market value perspective, or trading into the broader market, may not bring the same value as you would under fair value on the fair value context. So again, you're not going to find that in any manual or any definition per se. It's just how in my period of time that I've done this kind of work, how I've really kept a separation between those two definitions of value. Okay, understanding the applicable regulations and standards. Along the way, again, it really gets down to how your focus has to be what your purpose is in terms of who you're reporting for, and what the valuation process is around the scope of the project. Again, under Saudi Organization of Chartered and Professional Accountants, I'm assuming that's probably where your focus needs to be. Sometimes, and I've had experience where I'm working for a multinational company, and they have made acquisitions outside of the market in which their corporate headquarters is located. And depending on that acquisition, there may be some triggers for some of the subsidiaries to report under local standards, which may be outside that particular corporate users or corporate office headquarters. So again, an acquisition, a Saudi company making an acquisition that is another part of the world, depending on how it's structured, may require the valuer to look at that asset acquisition under the standards of that local market that may be outside Saudi. I've dealt with that myself several cases, and how do you handle that? Well, you handle it by obviously trying to find, working with folks on the ground that are relevant in those markets that can handle that for you, or develop those valuations for you. But in the end, ultimately, it's a process that requires some diligence and some understanding with the client as far as how they need to have the values reported. But I would say it's probably a rare exception. I think for the most part, what you're going to find, and again, that gets into we'll get into this in a little bit, that gets into kind of the engagement itself and how you work through that and define that and how you want to best attack that. But from a local perspective, if you're going to be probably dealing with that very, very little. It's just the point I'm making is that along the way, if you do find these situations occurring, you want to make sure you understand if there's any difference in the standards that maybe of the local market where the asset is located versus what you're reporting to the client. Okay, identifying the client, the end user, and their requirements. These are in big and bold because I think this is really critical on the front end of a project is defining the purpose, the scope, and the user. Okay, for the purpose, pretty straightforward. Why is evaluation needed? Generally, we're talking about here is financial reporting. So I think that's for the point of this presentation. That's what we're talking about here. The scope, what valuation questions need to be answered and evaluated. So, Paco asked me to focus on the real estate side of things, but obviously, under a corporate scenario, the real estate is could be one portion of an enterprise acquisition. There are cases, many cases where I work with corporates that are purely real estate acquisitions, which is a very straightforward for me, a very straightforward type of assignment. But sometimes, it's a multi-billion, real acquisition that, requires consideration of intangibles and maybe personal property. And at that point, you've got to identify, okay, where do the lines cross? Where do I cut off my responsibilities and then rely on other parties on the personal property side or on the business valuation side to do their part of the allocation. So that's part of the scope, is defining that, and then also ultimately where the reporting is going to be done. Where's it going to flow to? Is it just simply a balance sheet adjustment, or is it going to flow to other entities, within the other subsidiaries within the organization or within the parent? Those types of questions can have an impact, but the most simplest case is the one-off straight acquisition, of a real estate asset, and how do we treat that under a corporate and a fair value scenario. Then ultimately the user. Well, the users are it's pretty likely that that's going to be obviously the company that's engaging you, but then also it'll get to the auditor, and it'll get to potentially other folks. We'll touch on that in a minute. But I wanted to re-highlight again, going back to this presentation, purpose, scope, and user. The purpose would typically, again, determine the fair value to provide results to the client company for booking asset values, right? They made an acquisition. They need to bring these assets onto their books. They need to bring them on at market value, or I guess fair value. I don't want to mix that up on fair value. And that's the reason for the purpose for the work, right? The scope focuses on what was acquired. The assets can be owned and leased. The company's implementation of the reporting standards is based on, again, the entity that's been acquired. But own versus lease is critical, because even though there may be cases where acquisitions are made, there are requirements around booking leases or recording leases and analyzing leases that are relevant under IFRS that need to be addressed in many cases. And as real estate valuers, we can handle that work. We don't always do that. I think it varies depending on what the assets are and what the leases are. If they're leases, or if they're really contracts or whatever they might be. But it's a little bit of a different approach if it's leased versus an owned property, and we'll get into that in a little bit. And then always go into these situations considering all three approaches to value. Now, what I would recommend, and I think you will do ahead of time, is you'll have to, in your discussions with the client on defining the purpose and the scope, you're going to probably determine early on what the appropriate approaches are going to be based on the availability of data, given your experiences. So depending on the transparency of various different markets, I know a lot of times going into it, what approaches I can and cannot use simply because of the data that I know is going to be available. And I would think under a corporate scenario and a corporate approach, we're going to be often looking at the cost approach. The income and market approach, I think you'll see a reference here in the presentation later on, as a sales comparison approach. But it's really the market approach is one and the same, where you look at comparable transactions of similar assets. or the income approach, looking at a fair rent and capitalizing that rent. Those are also approaches that you want to consider given the availability of data, and we'll get into that more in a little bit. The client end user would be the company who completed the transaction and has engaged you. We've already discussed that. Okay, now here's a key point. Other parties that are likely to see your report and may request further explanation are certainly the auditors. Anytime you're doing anything for financial reporting, I will guarantee you it's going to go to an auditor to review and sign off on, and you can expect questions back from the auditors, and that can be very time consuming and very detailed. Tax advisors, I add that in here because sometimes the transactions also have a tax impact, and the work that you do, may be used, to support some tax analysis. And I'm not quite sure of the laws and regulations in Saudi in this regard, but I know in other parts of the world, the impact of the work we do under an audit scenario or under financial reporting versus a tax scenario can be a little bit different based on how taxes are reported in that particular area. So you want to be very aware of is your report going to be used for a dual purpose? And if it is, you want to make sure that you're addressing those issues, and also making sure that you're allocating the appropriate level of time and fee to do that kind of work. Legal advisors, typically, all the clients have legal advice. Legal advisors, it's pretty generally to be expected that they're going to want to have, if anything does come up, their legal counsel have access to any of your work. And then the last thing I'll bring up here is under governmental situations. Usually, this would not be done for financial reporting, at least in some parts of the world. Now, if there is a requirement, for working for the government and looking at government assets, they'll want access to your reports also. My point here is you want to make sure that you identify in your engagement letter everybody or those that are going to be looking at your report or using report, and you're comfortable with that. And to the extent you're not, you make sure that any exceptions to this need to be, clearly approved by you in advance, or some type of third-party release needs to be signed or put together to allow other folks to see your work. So I think it's very important to keep in mind. This goes back, it's more of a legal engagement letter type presentation, but I wanted to highlight this because, again, you have to understand that the work you do, if you don't control where it's going to go to, then it can go a lot of different places you don't want it to go to. And so I think this is a very, very important point I wanted to bring up. Users outside of the client should be limited to subject to the evaluation firm's approval. Reference within the engagement letter is critical. I've covered that already, but I wanted to highlight that. So for financial reporting, I think what I want to focus on here is I've been focusing on is the corporate side. I list, when I think about the real estate market in general, I think about it as we have a corporate user who need real estate to operate their businesses, need occupancy, need buildings to operate what their businesses require. And then I think about investments, which are real estate investment trusts or private equity funds, where you find sovereign funds that are perhaps investing in real estate and are the owner of the properties, but they rely. The whole point of those investments are income producing type assets with the office buildings, retail centers, hotels, things of that nature. What we're focusing on here really is more of a corporate perspective, and I wanted to make sure that everybody was aware on that. The investment side of things can be a little bit different accounting treatment, and that's a much different discussion. So I want to focus today solely from a corporate perspective and how we look at things. So I think it's more relevant for financial reporting that I think that is probably more applicable to those of you that work in the Saudi markets. It seems that under a corporate scenario that the obvious points of the allocation would be simply land and buildings, but you'll see here I listed a little bit different, which the terms seem a little bit redundant, but actually they're not. Where I see land, that to me is the dirt, right? The underlying land acquired, and sometimes it's surplus, sometimes you have excess land, but nonetheless it's the land. the buildings or the site or the improvements are put upon. Land improvements, site improvements, those are interchangeable depending on. When I look at fixed asset records, or I talk to clients, the idea between land improvements and site improvements, there's an overlap or interchangeability of the usage of land versus site. I see them the same thing, so I wanted to reference that. And in their fixed asset records, oftentimes it's identified as such. Then we have building and building improvements. And the difference I mean by that is that typically what I see when something is referenced as a building on a fixed asset record is the original building that was essentially added to the balance sheet at the time of construction completion. Building improvements typically are those improvements that are made once after the building has already been put in service. You have constant kind of upgrades and renovations and expansions potentially. That falls under building improvements when I think about that identification. And then the last thing are leasehold improvements, which if a client is leasing the land but owns the building, any improvements put upon that building while they're leasing the land are controlled by the building owner, but are considered leasehold improvements because at the end of the ground lease term, those improvements would revert to the landlord typically. And also leasehold improvements would be if you are if a company has many locations that they occupy, maybe a retail user, and they have leased the space out, but then added certain improvements themselves, to the improvements provided by the landlord. Any of those improvements are considered leasehold improvements and come on the books also. And we'll get to a little bit on the issues with the fixed asset record here in a minute, but those are all generally the kind of land and building breakout that I would think about under a corporate scenario when I look at a corporate fixed asset record and think about my allocation for the real estate. And then lastly, here we under IFRS 16, that deals with leases, and that really gets to more or less lease recording treatment. And so there's really two. If you think about it, you can lease the land, and then obviously the improvements on the land typically would be owned by the occupier during that lease period. However, at the end of the lease term, it would revert to the ground lessor, or you can have a lease of the facility or in property, which typically I see that as being a lease to the land and building simultaneously. That's more common. I have seen situations where and I think a lot of it's due for tax reasons, where I've actually run into cases where you've got a ground lease, you're leasing the ground, but then you're also leasing the building. But it's it's atypical to find a pure lease of the building only. Usually you find a lease of the land only, or a combination of the land and the building together. And so, that I don't want to dwell too much on that, on the case of a building only lease and having really two leases. It creates a whole different challenge, from a financial reporting standpoint. But nonetheless, it can happen. And if it does happen, you got to kind of step back and kind of look at it almost as two properties or in two analyses to do any kind of analysis around that. And the analysis that we normally do is that the companies typically will book a lease liability on their financials, and they'll be amortizing that over the lease period. And so that's pretty much given the lease agreement based on the committed terms. Usually it's based on the committed terms. It's not based on options. It's not based on some future assumptions. It's based on contractually what's in the lease agreement. They'll actually book a lease liability. And then under IFRS 16, there's a right of use asset, which is the essentially an offset to the lease liability, and that's now booked as an asset. That's a fairly new addition in the last couple of years to lease accounting. And that right of use asset usually is an offset again to that liability. The challenge is that when a transaction occurs, that needs to get the right of use asset needs to get reset. Typically, the liability doesn't change at all. But if a transaction occurs and they've previously booked a right of use asset, that right of use asset has to be re-examined. And by that I mean you look at where the market today at that point in time would have been, and if there's some adjustment to right of use asset, you make that adjustment at that time. So, for example, an asset, a right of use asset, and a liability was booked in 2022. In 2023, the company is sold, and that right of use asset then gets reanalyzed, and say the market rent has dropped 10%. That right of use asset, in theory, should get adjusted to reflect that change in rental rate or a change in market. So it's more of an off market. We call it an off market type of adjustment, but that needs to then flow back through the right of use asset. So this is something that's come up in the probably in the last couple of years, and very important. Most companies have now at this point especially public companies, have had to make that adjustment. A lot of private companies are doing the same thing again because of transparency reasons and trying to be consistent, with what their investors want to see. Okay,
Jim,
now I'm sorry. Go ahead, Paco. Sure.
Yeah, thank you. And thank you very much. At this point, I wanted to interject with a couple of questions that we've had come through. I'll handle the general ones first, and then there's one specific to the presentation. So a number of people were asking if they can get this presentation. It's going to be posted on Taqiim's YouTube channel, so you can replay it. In terms of the slides themselves, once the necessaries are sorted out, we will send the slide deck to the webinar participants. In terms of I think one person was having an issue with seeing the slide deck. I responded to that privately. I believe everyone else can see the slides, so it might have to do a reset on your side. So Jim, one specific question from Hasim Ali, in terms of capitalization of rentals or income streams. What he wanted to know was, can you please detail it out in a bit with an example, if possible?
Sure. And we're going to talk in a minute about the valuation processes, but what I will say is the income methodology that in it all, again, in a perfect world, what I would tell you is you're going to be able to, even though a property may be occupied by an owner user, ideally there are or lease transactions in the marketplace where you can look at what a fair rent would be for that particular asset. Now, in markets that are less transparent, what I typically will do is I will look at perhaps a fair return to any improvement to the cost via the cost approach. We'll get a fair return back to that to come up to calculate potentially a fair rent. It's a little bit of a circular calculation, but so you have to be very careful about those kind of assumptions and what the implied return might be. But generally what we do is I would try to create a pro forma income statement, looking at what market rent would be, and then applying that to the square footage or square meters of that facility to get to a market rent, a gross market rent. Obviously, there's always some type of expenses around this you want to factor in, depending on what the lease terms are in the marketplace. Some markets have full service leases, some have gross leases, some are triple net leases. So you've got to understand how your market operates in that regard. But what you would do is you would take that fair rent estimate, multiply it times the square meters or square footage of that facility to get to a revenue number. You would deduct. Oftentimes what we'll do is we'll deduct for some type of level of vacancy. If you look at your market and you have a very high vacancy market or a very difficult market to release in, you might use a double digit type of vacancy, a stabilized vacancy number to deduct off that revenue. Once you've done that, you would also then deduct some level of expenses if they're that wouldn't be passed, that the landlord would have to pay out of their pocket, that would not be passable to the tenant, to get to that revenue, to get to that net income line item. And then you cap that rent, and normally the cap rates that really you typically come from market transactions. But again, if you're not in a very transparent market, you look at surveys that are provided by different entities. There's a lot of surveys done by the various brokerage firms that we will rely on, especially in markets that are a little less transparent. We'll leverage off of broker opinion in terms of those views around the cap rates, and we'd apply that to that net operating income to compare that to our other approaches to value. So again, I think that the challenge with that in a financial reporting scenario is that generally the participants in that transaction aren't always leasing space, or are not in markets where rental is common. And so developing that rent can be challenging, but nonetheless there are ways to do that. And we try to do the best we can relative to all these different levels of information and sources. And from there, I guess Paco, we get to our results the best we can. But I know hopefully that helps kind of summarize. And what I could possibly do is add a slide in the final presentation, just showing that a direct cap method, if that's of any help. I'm happy to do that. But that's how we would approach it in any market, with the best case being having actual lease transaction data to leverage on, versus one that's not a very transparent market, not a very active rental market, and having to kind of build that rental up, based on a whole host of assumptions that, frankly, there is some subjectivity involved that creates some challenges.
Thanks a lot, Jim. That really helps. Yeah, and with a final slide deck, we could always put in a direct cap method, which illustrates this a bit more in terms of an illustrative example. Hasib, I hope that answers your question. Another question from Hasib. I think it's an elaboration on the first question, because it's also in and around leases.
Okay.
The question is, if there's a party with a right of use asset for a period of, let's say, 20 years, so a leasehold term of 20 years, and they want to contribute that leasehold land, so the asset is defined now, it is land, in a project in exchange for equity in kind. How do you see the valuation of equity for the leasehold landowner? How would that valuation of the leasehold land be treated as a contribution?
Yeah, that's a good question. It's a complicated question, but so we find that, first of all, and I think in certain parts of the world, that type of investment is more common than others. And so, where especially when there's a lot of government control in land, where you have a favorable position, and want to make that a monetary type of return on that position. Generally, the longer the term, the better. I'm seeing a lot of ground lease transactions or movement is being more typical now than it has been in the past. But I think under that scenario, the first thing you want to make sure of is that the longer the term, the better, because if you have a situation where that control is going to be lost in a fairly short period of time, there's very little value to that, typically, to a new investor. So they're going to want to see the length of time around that remaining lease term. And then what we normally will do is we'll look at, okay, what is the outflow? What is the contract rate on that ground lease? Okay. That's kind of that's your expense side. What your revenue side would be, okay, where would the market be? So to be attractive to an investor, there must be a play there where there's a favorable position in that interest, or in that position to sell that particular asset. So you look at the differential between what it would cost, or what the market today rent on that land would be, versus what the contract rent actually is. That differential should get you to that spread. You would treat it like a discounted cash flow, and you would run the cash flow over that 20-year period, or whatever the period might be, to get to a value, discounting it again at a rate that, again, subjectively, you've got to go to the marketplace and determine, okay, what's an appropriate discount rate for this kind of cash flow? How how safe is it? Who's, a lot of it is predicated on who's paying the rent, because if it's a very highly thought of company, high rated company, versus one that's not in the same level of that, the discount rate can differ, but nonetheless, you look at that differential between a market rent and a contract rent. Look at that spread, present value of that spread, and that gets you to, in theory, some value that would be reflected, or would be a purchase, theoretically a theoretical purchase price that someone could justify based on that, on those types of assumptions around those returns.
Thank you, Jim. One more question and we move on.
Okay.
I figure we're going to get the answer from the rest of the presentation anyways, given us we're at the evaluation process and challenges.
Sure.
But the question is from an anonymous attendee, and it says, can you give more clarification between the difference in market and fair value, and what is the impact on the valuation methodology? Phrased another way, same question, is what's the difference between market value and fair value, other than it being used in financial reporting? So those are the twin questions.
Yeah. And I think those are good lead-ins, Paco, because I think we'll be addressing that here. And again, we'll be addressing it at a very simple level. But I will try to illustrate here momentarily the difference between the two, and why the values are, could be different. Now, there are cases where when you go through your analysis, there is no difference ultimately in terms of what the value might be, but I want to show an example of where it would be different, and I'll be bringing that up here momentarily.
Great, thanks, Jim.
Okay, we'll go forward then. Okay, the valuation process and challenges. I've addressed this to some degree already, but the three approaches to value. Again, the sales comparison here, really, I think for most people, the market approach, this is more of a use PAP. Given my U.S. base is more common here in the U.S., but it's a market approach. There's no difference between a market approach, comparison approach, or sales comparison approach. So when you look at this, think of market approach. But again, you want to go into any valuation, but even for financial reporting, assuming you're going to be considering all three approaches to value. And along that way, what are key considerations? So normally you're hired to do a financial reporting valuation. Oftentimes it's around a new acquisition. So you want to understand what the acquisition price is. Now, if that acquisition price is purely for a facility, then that's pretty straightforward. Okay, well, whatever the purchase price was, you're going to allocate to that number specifically as part of the real estate, and that's because real estate is what was acquired. But if the acquisition is of a business enterprise, you along with the other counterparts in the personal property or machinery and equipment side, or in the intangible side, the business enterprise side, need to go out typically, and you do your own independent analysis evaluation. You come back and you add those up together and see how that translates to the acquisition price, and then see where you need to tweak any of those values to get by tweak I mean adjust values to get to that acquisition price. And so it's kind of putting a puzzle together when you've got more than one asset type. When you have real property, personal property, and business enterprise value, it's more of a pie, which I think in previous presentations you've seen this. If it's just a straight real estate deal and the acquisition price and all, you're going to take that number, and that's the number you're going to allocate to purely for the real estate. The fixed asset record is very important. Generally, it's probably used more heavily by the personal property and machinery and equipment people, because there's a lot more detail around individual parts. But for me, I've always found that be very important, because the fixed asset record tells you the historic cost, typically what they've invested in the property. Even if the information or property was built 15, 20 years ago, and it's probably been fully amortized at this point at the time of the transaction, it's good to see that, confirm that, and see that timeline and see where things are at. So the client can understand why there might be a step up in value, even though the property's been fully amortized. You're going to have to step those values up, based on what the net book value is. Net book value being the historic cost less accumulated depreciation gets you down to the net book value. And so sometimes that net book value can be fairly substantial in that it may be a new construction or a relatively new construction, or they can be pretty low based on a long-term amortization where the buildings were built and entered into service, 10, 15, 20 years ago. And the date of the fixed asset record is important because, oftentimes the transaction date, normally the valuation date is the date of the transaction. Sometimes because of timing, the fixed asset records haven't been updated for a few months. So you need to reference the fact that you're working with a fixed asset record that might be a few months old or could be older than that. And then you want the opportunity to true up your analysis if there's some additional information that you need to consider. But this is less of an issue for real estate than it is for personal property. But I wanted to bring that to your attention. I find it's very helpful because the fixed asset record also kind of gives you that layout and how the company's been looking at land improvements, building improvements, and leasehold. So it helps you identify, how they've been categorizing things and making sure that you have an understanding of where that is. But typically our valuations, we'll value the whole. We don't value to the individual component in a fixed asset record. We value the whole property, and then we'll leave it to the company to take so if our building value is 10 million real, and on the books you have something similar, or you have like say 9 million real on the books, that 10 million is just usually allocated by the company. We've done this before. They've asked to do this before, but frankly, a lot of those improvements are very short term, very temporary. So the reason we don't want to go on individual assets is because it's really hard to break it down individually and to understand the various lives of these different additions. So we simply say, here's the aggregate value, and they can allocate it then however they want to allocate it to the previous book values. And sometimes, it's a way for them to kind of reset their books and eliminate a lot of this superfluous information that maybe is older, that's no longer relevant, and kind of reset their books. But generally, we don't allocate down to the individual assets on the books for real estate. We simply give them a real estate number and let them kind of proceed however they want to proceed on the allocation further. Not that we can't do it, it's just that it's a more timely and more costly process that the company probably is better served to do it themselves. Again, I mentioned interaction and coordination. If it's more than just a real estate deal, with the other experts in the personal property and the intangible side. And so you've been asking about the fair value versus market value example. So I'm going to give you a very simple one here, but let me move to that here. So under fair value, as I said before, the way I think about it, and the way I justify, rationalize the approach that I take on this is I look at fair value from a corporate perspective and a user perspective. And so in doing that, normally the primary approach that we've seen in these cases is a cost approach methodology as a starting point. And so, again, the line items here can vary, and I'll give you some discussion about this here in a second. But you have the replacement cost new, which is really kind of the really have more think about it in terms of hard costs. We have additional soft costs, which again may or may not be relevant for what you're doing. Sometimes we have these cost manuals, and there'll be kind of a footnote in the cost manual say that there's certain soft costs that aren't included. For example, there's no estimate for legal or financing or architectural or maybe general contractor additions. So sometimes, depending on the basis of that information, we may add some additional soft costs on top of the replacement cost. But if the manuals you're using are indicating that, hey, we're including everything in here, then you wouldn't have this line item in here. But we show that in here as a typical line item that I usually experience and see. The entrepreneurial incentive is kind of developer's profit. That number is in usually if it's a we'll see that if it's a property that's fairly pliable in terms of other users or other types of developments. There are cases where I've done work in the clean room fabrication industry or in the data center industry, which corporate data center side, where specifically the companies are spending multi-billion dollars of real on their own data centers or on their own fab facilities, and so they're not building with any purpose to get any profit out of this. They're building it for a business purpose, and so there have been cases where I've put 0% incentive at all, because that's not their goal. Their goal is not, the goal of the real estate is not necessarily to be an investment. The goal is to be supporting of the business. And so in those cases, this incentive would be zero. But 10% is a fairly common one if it's a situation where the asset is fairly consistent with the other parts of the marketplace and could have an alternate use. So again, those numbers may or may not be in your case. I would just say you have to kind of defer to the quality of the information you're getting from your cost manuals. The depreciation we have here, physical depreciation, pretty straightforward. Usually we use an age life, which might mean by age life, if a building was built 15 years ago, we'll often start with, okay, if it was built 15 years ago, we're going to assume a 15 years of life of the building has passed. And so then the bottom of the denominator becomes the economic life that you, in your interpretation, thinks the facility has. My experience and looking at the manuals that we've worked with, it can be anywhere, depending on the asset type, anywhere from 40 years to 60 years. So really, you take that numerator of 15 and then apply a denominator. It could be 40, 45, 50, whatever that number might be, to get to a depreciation number. Here, it's about a 30% depreciation, which implies probably like a 50-ish age life for the building. But again, it's a fairly simplistic, straightforward type of approach. And in the case where, the building is built in the last 15 years, it's a pretty easy calculation. But for some reason, sometimes you get into certain markets where a building may have been built 50 or 60 or 70 years ago, but it's been rehabbed, renovated, and in really good condition. In those cases, we have kind of the latitude to determine a somewhat different number, and it really becomes very subjective to the valuer. And so something built 70 years ago, but it's been rehabbed, several times in the last, 10 to 12 years or 10 to 15 years, we might say that is 15-year effective age and a remaining useful life of 35 years. So there's some subjectivity around that when you find structures that are very, very old but still have a lot of remaining life to them. So I'll leave that, that's more of a discussion, on a case-by-case basis. But again, our age life method is kind of how we look at the physical depreciation. And then below that is this functional and functional obsolescence and external obsolescence. Functional being normally we interview the facility people that are part of the acquisition team or the team that runs the facilities. And we'll ask them, we'll say, look, if you were to rebuild this structure today, what kind of things would you do differently? If they come back and say, well, we would remove these walls and we would have, put a retention basin over here, things of that, things like that. We would, 1 second here. We would, maybe calculate some type of functional obsolescence. So for example, if it costs maybe, $1 million real to move some walls around or to add certain functional improvements to the building, we would deduct that here. But in this case, we're assuming there's no functional issues. External means that you place the asset in the marketplace, the broader marketplace, and that you would not build this property today as is, because the broader market wouldn't support the cost to build the facility. You'd only build under the scenario that you can turn around and make some level of profit on the property, which is why in this case, external obsolescence is not taken, because we're talking about a user who needs a facility for their business operations and really is not necessarily concerned about the external factors. So this is kind of where market value and fair value diverge, is that you have these functional and primarily external issues that you need to factor in under a market value, which you wouldn't factor in under a fair value. So we run our numbers here and come to a conclusion after depreciation, and then add on just depreciated values for site improvements. Generally, we'll do a separate. We don't incorporate site improvements within the building. A lot of times, I prefer to do those separately because they have a lot shorter lives. So things like parking and landscaping and, well, parking structures, parking lots, landscaping, lighting, exterior lighting, retention basins, whatever you might have, that all falls under site improvements. So we typically go there, as a separate, based on separate remaining useful lives. And then we add the land value to that. You could have surplus or excess land, which typically means, excuse me, which typically means excess land might be additional development land. A surplus land might be land that the way that the building is configured on the site, there's the ability to expand. So there's a little bit differential between what's defined as surplus land or excess land. We won't get into that, but if it does exist, it's added to your cost approach. And we get to a net number of 29 million real here in this particular cost approach. The physical depreciation, the weighted average remaining useful life and site improvements is a little bit different than the building that I said before. We run separate calculations. A lot of site improvements we typically find have 15 to 20-year lives. Buildings themselves often have more like I said, 40, 45, 50 years, thereabouts. So again, these numbers do vary, and we do try to develop them. But again, this would be your cost approach. And this is a typical corporate type of fair value that we would be a starting point. Then we would take this and compare this to their book values to kind of estimate, what type of step down or step up we might be looking at. And then what we would do in under a fair value scenario, we would still look at income and sales potentially to have an understanding, what the variance could be under those approaches versus the cost approach. If in fact those approaches align very closely with fair value, then I think in that case we would argue market value and fair value are one and the same. But here under market value, we do a market approach. We're able to do an income approach and a market approach. And we come up with numbers of real of 22.5 million and 23 million under each approach. Again, the income approach derived based on the methodology that I suggested in the earlier discussion. The sale or the market approach being, comparable sales of similar facilities. It's hard. Sometimes it's very hard to find those if the current use is so unique that any comparable sales don't necessarily support what you're trying to value, but sometimes we'll use that as to get a sense of the broader market, what people are paying in the market on a price per square meter, price per square foot, or price per kilowatt basis in those markets, and to see how that might compare to what our cost approach is coming up with. But again, here these approaches suggest certainly a variance from a cost approach or under a fair value, where we see this differential here highlighted, that we're saying that under the cost approach we have a value of 29 million real, but under the income and sales approach, we would be given the data available and the broader market in this location, roughly 23 million real, suggesting about a 6 million in external obsolescence, or 21%. So this is a fairly simplistic presentation in that regard. Again, obviously there's a lot of work that goes into making these numbers occur or coming up with these numbers, but that's the distinction I see between fair value and market value. They can be one and the same, but you've got to run through the numbers, and when you have this kind of gap, the company, under fair value will likely still book the 29 million real. But what happens is if that company decides they no longer need that facility, and they put it on what's, and we'll get into this in a little bit later. They put it on as an asset for sale on their balance sheet. It basically gets taken out of their balance sheet. It gets put in a separate category, and it being held for sale. And you take this price or these values, more like 23 million, less some sales costs, potential sales costs, and get you down to a revised value under that scenario. So again, there's a lot of levers that can be pulled here depending on the purpose and what the result, or what the company is dealing with in terms of that particular asset. But in this case, if someone asked me what's the fair value, I would say 29 million. Well, what's the market value? I would say it's probably 23 million. So that's where we see, this difference. So again, a very simplistic case, but I wanted to bring that up and bring that to the attention. Paco, before I jump into the audit process next, any other questions?
Yes,
around
exactly.
that?
Yes, you did read my mind. Yeah. So thank you very much, Jim. That was illustrative, and that answers the questions we're having earlier on about the difference between market value and fair value. I'm going to handle a couple of the Arabic questions now.
Okay.
They have been translated, so I'll read them out in English. I hope I capture the essence of the questions accurately. If I do not, just retype the question and we'll address it again. So there's a question from Yasser Al-Atlani, and the question is, from my understanding, I'm going to read it out literally, and then I'll say what I think he's getting to here. In the event that the company rented a property owned by it, but found that the amount of rent is low, is the valuation done based on the amounts in the lease contract or based on the rental price in the market? So, Jim, I think this is a classic contract rent versus market rent scenario. So what would the valuation be based on? Would it be based on what the contractual rent states, which is the rack rent, or would it be based on what the market rent is?
Yeah, if the task or the purpose of the analysis is to calculate market value, not fair value per se, then I would look at the well, let me step back a second. This concept, we don't necessarily see it a lot under fair value. Where you acquire an asset and the contract rent is below market, generally we would look at this on the basis of that contract rent, to the extent that there's a long enough term remaining where the buyer would be looking at it from the perspective of capping that contract rent. But if it's a fairly short period of time, what we typically would do then is we would take the market rent and apply that and come up with a number, a value based on the market rent, and then we would look at the remaining period of contract rent that's below market and present value that, and either you can do this in a cash flow model or in a direct cap model, where you can present value that remaining below market differential, which is a negative, right? It's going to be a negative. It's going to be a deduction, and you would deduct that from your value under the market rent. It's more of an investment approach. This is more from an investor perspective, which is fine. I can move across either fair value and market value easily. So again, I would look at the remaining lease period of that contract rent, and then I would look at what the purpose of the valuation is, and if it's market value, then it would be, you would take market rent and deduct off the contract rent, or look at that differential for the period of time and present value that as a deduction to the value of the property under market rent assumption. If it's under a fair value assessment, then generally it's not as much. It's not, the issue is more of a case of be more of a case. That's if you're the buyer. Let's put it that way. That's if you're the buyer. If you're the under the fair value, you're looking at it from more of a corporate perspective, and that corporate entity is acquiring an asset that has that situation in place. It's really just a matter of reporting the right of use asset, adjusting the right of use asset around that particular transaction. So I think the way the question has been asked, Paco, I would say this is more of a market value question from an investor perspective, which is fine. And the way I would approach that would be to look at market rent and get to a value based on market rent, and then I would adjust the present value of the the rent loss over that holding period to the market rent value, to the market value, to get down to a fair, I guess to get down to a market value based on the current market rents.
Thank you very much, Jim. Mariam has a question. It's a fairly straightforward one. Mariam, you wanted to know if you'd be allocated CP hours for attending this session. The answer is yes. You get 2 CP hours for the 2 hours of the presentation plus the Q&A session. There's one more question in Arabic, also once again translated. It says, in the absence of accurate market data to ensure that the rentals are compatible with the market, which may then affect the final value, what is a useful way of confirming or avoiding a misleading market valuation, basically, or fair value in this case? Jim, a slightly loaded one. So basically, this needs some data and inputs. If there's not enough data, how do you ensure that your valuation is accurate, be it on the
I think
value basis?
First thing, as a valuer, you always want to make sure you cover yourselves on these types of situations where there's limited transparency, where you have to insert some limiting conditions around what you're concluding to. And so in that particular case, if I go into a very untransparent market where there's not much in the way of data available, the best you can do is hold conversations with folks that are in that market and ideally that have done transactions that might be able to share information with you. Because of proprietary information or proprietary and non-disclosure type information, it's difficult to get all that. So in the end, coming up with a valuation, you have to obviously provide whatever limitations you had in that analysis, so the reader and the user of the appraisal understand, look, there's some limitations here. I've done the best I could with the information available. However, there are some restrictions that I'm dealing with, and so my value, is impacted by that. And should better information become available, I kind of reserve the right to make an adjustment to my valuation. If you're in a case where there's so little information to begin with, you may want to look at that and have a discussion with the client and say, look, what are our goals here? Because, I may not be able to give you an answer. I may not be able to provide that kind of level of information to you. So I want to obviously be proactive and say, look, I want to help you the best I can, but to the extent there's limited information, it's going to impact the results. And so the reliance on this, I want to make sure the reliance on this is you understand that going into it. There's some restrictions and limitations here. So, and again, I know there are a lot of markets that it's difficult to acquire data and information, and we find those, when I find those situations, you try to figure out what are the best proxies. Okay, it does become with discussions with people who understand the market or work in that market, number one. Number two, getting their perspective if you can. You can look at industry surveys, but those surveys are very broad and usually, provide averages or ranges. I found that actually, especially in areas that are not very transparent, having those kind of ranges are helpful, and it gives you some basis. But I think ultimately you got to kind of step back and look at what the risks are associated with the asset class, and who the occupant might be and who the user might be, and their ability to operate or to pay along the way. And so you have to kind of figure about the risk profile at that point. And it does become a very subjective process as a valuer. How I might look at an invest or at an asset that's occupied by a AAA company versus one that's a C- type company. You're going to have different results and different conclusions with the same set of data, right? You're going to have different results because that one's at a higher risk profile than the other one is. And so within those ranges, you need to make the appropriate adjustments in there, very subjectively, obviously. But again, when you do that, you want to make sure that you document any limitations that you dealt with, so that the user knows that, look, use at your own risk, because these are some limitations that I had to deal with. And if you find those limitations are so hindering, you're better off not taking that on, or passing on that particular level of work, because it's very difficult to do that. I know, Paco, in our case, and we experience this for sure in the work we've done in the Middle East, and it is very challenging. So you've got to be nimble in terms of changes that are being reflected and made, but you have to document all the changes that are being made and make sure you have a paper trail on these types of things, because when you get these very broad shifts in assumptions or in information, it can massively change your value conclusions. And as a result, you just want to cover yourself in that regard, and have the best level of information available to you on a paper trail to support anything you've done.
Thank you, Jim. Just to add on to that, right? Jim captured it perfectly. To a large extent, right, it's about transparency and documentation, right? Part of our mandate as valuers is to enhance public trust, and that includes stakeholder trust, the client's trust. So be clear with the client what your limitations are going to be. If it's near impossible to find suitable comparables, then in some cases, you may not be able to do like a proper or detailed valuation. But the other test is, what would a competent valuer do? If you know you've trawled the market, you've looked at your data and inputs, assembled them in the best way possible, so that a peer reviewing that work would basically certify that work as you've done the best you could under the circumstances given that information, then I would say it passes the test. It can get really expensive. We've had cases, a project I worked on in the Middle East with Jim, where our comparable data set was not within that country. It was a GCC country. We basically had to go wider and basically look at other GCC countries for comps, because the nature of the asset was so unique, we couldn't find similar comps in country. But the client had to pay for that, right? So you look at the client's budget, what they can pay for, how you can make your work as accurate as possible. And in some cases, if you're caveating it or limiting it so much that the valuation cannot be used for the purpose for which it's required, then you may need to have that honest conversation with the client and let them know that it's not doable in that case. Yeah, thank you. Jim, I think we can continue from here.
Yeah.
Get back to questions at a point where it's
Okay.
reasonable.
Yeah, well, we want to get through the fun stuff here, the audit process, which is really really exciting. So So again, the status we're at now, you've done the valuations, you've reported it to the client. How does this all go through an audit process? And again, guaranteed, if this is for financial reporting purposes, it's going to go to some level of audit, outside audit from the company. And so when we know this, it is somewhat, the process I go through is that I look at the deal size, right? And so depending on the deal size, that'll probably require you to maybe spend a little bit more time if it's a high multi-billion-dollar real type of transaction, or enterprise transaction, versus one where it's maybe 1 million real single acquisition of an asset. It's going to require different levels of discussion, with the client, and then also with the auditor. So I say pre-project discussions, before as you're putting your engagement letter together, you want to have these discussions to make sure you identify the scope and purpose within your engagement letter. And that requires discussion with the client, obviously, but in some cases, because of maybe uniqueness or challenges around the valuation, if there are some nuances to it, you may want to have that discussion with the auditor too. One example I can think of off the top of my head is when we work with corporates that acquire another company, and that company has multiple locations that they lease, like say distribution warehouses or logistics centers spread all over the country and sometimes all over the world. We look at that and say, based on accounting policies and IFRS, we should be looking at all these leases depending on certain metrics. If for example, they have 100 leases, is it realistic, or is it necessary to evaluate 100 leases, right? Do we need to go through that process, or can we look at kind of the bigger ticket, bigger cost leases, and identify some level of maybe filtering and sampling of that information to get to a result? And so that may require some pre-clearance with the auditor Similarly with owned properties, if you've got, again, a property with distribution centers, logistics centers they own worldwide, but you're in some very low cost markets and very high cost markets, can you sample those and do a valuation at the top 50 or top, if there's 100, maybe the top 25, and then look at that from a broader perspective, assuming there's some synergies and similarities, prototypes of facilities that can be then expanded to the broader holdings. So those kind of discussions can happen on larger projects. On smaller projects, usually it's not necessary, but I bring that up because it's something that's very important to have and really impacts your engagement letter. Again, checkpoints during evaluation process. Most clients will want to have an update or you want to set a time. If the work's going to take you longer than a week or two, typically it's going to go over a span of several months. They'll want to have checkpoints and check in on a regular basis. So usually every week to 2 weeks, we'll do a check in on progress and things of that nature. It can be formal, it can be informal. Informal might just be simply an email exchange, but formally we get on a call and some folks want to talk through things and where things are at and things of that nature. So again, that's an important point. And obviously the bigger the deal, the more checkpoints you're going to have. There are some sizable transactions I've been involved with that the other day we were responding to another audit request, and it's been going on for a year, right? So sometimes the bigger deals and the challenges that go on, can go for extended period of time. So again, some of these can go on very long, and others, are not quite so long. But you kind of expect the unexpected when it comes to the audit process because it does take some time. The deliverable again. Usually we set this in our engagement letter. What I like to do is, and again, everybody's different, is provide initially draft schedules, which show values and allocations. That's because you want to get to an agreement, before the report's being written at all, with the company and hopefully with the auditor on the results, on the financial results and on the allocation results. And so what I will typically do is provide draft schedules, have a call with the client, have that review. If the client's comfortable with the results, have a follow up then with the auditor, typically have those discussions. And then if all looks good, we'll go on to the draft report. I'll show you here in a minute, though. Usually those draft schedules then elicit questions that need to be answered, and we'll get to those in a minute. But again, what I wanted to reference was that I like to go to schedules first, so we're not set on a draft report, and then go to the report process once the draft schedules have been approved. And then that review process is really along the whole way. That's the last bullet point, but that occurs along in every step, the draft schedule step and the draft report step. There's a review process along the way and all that. So I want to show you a couple of examples here of audit questions. And so what they normally do, and so auditors, again, I've not been although I worked for a company, an accounting firm many years ago, where I worked with our auditors in that company and went into, as a valuation expert, went into companies and basically prepared audit questions for the company themselves. There's a stringent requirement that accountants have and auditors have in terms of tracking everything they do, and as part of the accounting process, there are certain benchmarks they have to meet to follow the IFRS or whatever the case may be, depending on what their accounting standards might be. But there are things that have to be followed and have to be documented by the auditor, which is why we go through this process and why they have to go through this process. And so you look at they come with a question, and their question can vary along the way. And these questions are kind of random in terms of the kind of property. One has to do with parking, one has to do with a hotel, one has to do with useful lives. So I mean, it can cross all different levels of the valuation. And then they want your response. So normally we get these questions, and depending on the situation, we can respond pretty quickly, or it may take a while to respond because the question can be pretty complicated, and we want to make sure we're thoughtful in responding to it, and making sure that we look at their point, especially if it's a point about calculations. we want to go back and make sure our calculations are correct. I hate to say this, but sometimes, mistakes are made from a calculation perspective, and you want to minimize those for sure. And obviously, the client's not happy if they come back with those kind of errors. And so I would say that it's very important to have quality control done ahead of time before any of this information goes to the auditor and goes to the client itself initially. So quality control is a key. So hopefully your response is going to be, you reference it, the calculation, how it was made. Now, it doesn't mean they're going to agree with it necessarily. And if they do agree with it, you look at your response date here, and then your status is closed. They agree with it. Okay, great. You go to the next one here. You respond to their question on the market data support. You provide this information. When you provided it, the status, it says reviewing. It means they haven't closed on this one. And what'll happen is, oftentimes we'll get a second response, the auditor response, after the status, with more questions around this particular comment or this particular question. We'll respond back to that again. That may not suffice, and usually 2 or 3 times down, if it happens, if the question goes on for 2 or 3 iterations, normally what that elicits then is a phone call. And I think under audit, and again, I'm not an auditor, have not been for many years involved with that directly with an accounting firm. But I think there's probably an internal requirement after a certain point in time, a direct call has to be had if you can't come to a resolution on a point. So again, in this case, reviewing, if there could be, to the right, there could be 3 or 4 iterations going back and forth. If you can't come to an agreement, then you have a discussion around that, live discussion. Again, these are other examples of here a question on a lot of international multipliers. There's a question here on this. I can tell from the presentation that this question on market and exposure time, this is a U.S. based company asking about this, but it's a non-U.S. owned asset. So this question is under IFRS isn't relevant. IFRS does not deal with market and exposure time. That's only a U.S. use PAP type of comment. So this tells me the reviewer is not necessarily up to speed on IFRS, because this would not be a question. Although we provided feedback on it, it's not a question they normally would ask. But nonetheless, depending on the market you're in and where the asset is located, you may get a question specific that's necessary around that. But again, we see these questions come up. We close them out, and there are cases where we don't agree, and we've had, I'm going to call it philosophical, but we've had differences in terms of calculation, how things are calculated, how, especially when it comes to different types of values. We haven't covered, liquidation value here, but sometimes, companies are and the assets are in such disarray that you're trying to figure out what the bottom might be, what the worst case could be. And there's arguments as far as how low you can go from a liquidation perspective. And so, there have been cases where we haven't agreed with auditors on their approach versus ours. And what happens is that the auditor, they carry the big stick. So they, they can put a lot of pressure, on you for results or from their point of view, because they want to be able to sign off on it. But if they can't sign off on it, the company doesn't like that. That creates an issue for the company. If when investors or with oversight comes in and say, well, the auditor suggested this, but you went a different direction, that's not great. Technically, the auditor generally the company may then defer to what the auditor is suggesting, and then not settle on our analysis, which is fine too. But we've had cases where we've been absolutely in total disagreement, and we weren't willing to come off of that. And at the same time, the auditor wasn't willing to come off of it. And so it becomes an exception, which is not a good thing, as you would learn, within the audit world and also within the corporate world, to have exceptions. And so it doesn't create a lot of goodwill for anybody. So you try to avoid those situations if you can, but the reality of it does happen. But nonetheless, it's a pretty intense and can be, again, the simpler the asset, the simpler the audit review, but the more complex it is, again, this can go on for months, and in some cases beyond a year, depending on the situation. So again, from audit, I wanted to then jump into just some relevant information reminders as far as I think you've been exposed to before. And these kind of get into exceptions. Sorry, go ahead, Paco. Sure.
Yeah, before we move to the standards application and the relevant information,
sure.
Just wanted to field a couple more questions.
Sounds good.
Yeah. So there's a question from Mohammed. It says, is it possible to use the comparable method if the property generates income?
Yes, I mean, it is, but it becomes, if the property is generating income, the comparable method usually, well, in my experience, I use that as a benchmark to the income approach, because obviously if it's generating income, then generally you're going to rely mostly on an income approach typically. Now you consider all three approaches still. Doesn't mean you complete all three approaches, but I always like to have at least a second approach as a check. And so you have that income approach, it's generating income, you have a value based on your income approach. The sales comparable method the market approach method is a good method to look at, price per square meter, price per square foot, price per kilowatt, whatever the case may be, and you use that as a benchmark to your income approach. But I think you ultimately, to answer Mohammed's question, I think I'm going to rely mostly on my income approach. But if I come with my income approach and it gives me a result that is outside the range of transaction information, I kind of step back and I want to make sure that makes sense. But I would probably, in all likelihood, I would not rely on that. I would rely on that sales approach, the market approach, if in fact it was not generating income, but I was able to find sales by owner users or acquisitions by owner users. I would use that more. I rely on that approach more than I would an income approach in that situation. But in the situation Mohammed references, income approach would be my first preference, benchmarked with hopefully a market approach, and if not, maybe a cost approach, depending on the asset type and the information available.
Thank you, Jim. That helps a lot. One more question. Okay. All right. This is a general question from Nashua. Wants to know what time the session will end. It ends in 30 minutes. It's a 2-hour session, so I hope that answers your question. There's another question where it says, is it recommended to use the extended life method when valuing the property using the cost method? I'm not too clear on that question. Jim?
I think the extended, well, I don't know if I answer this right or not. The extended life, I think, where in a situation where you've got I'm just speculating this, but when I think of extended life, I'm thinking about cases where your normal economic life for a building is say 50 years, but the building was built 100 years ago. Obviously, and it's been, and around the world, there's many situations, many cases like that where you would find buildings like that. So, what do you use there from a cost perspective? I would still look at that. Now, it has, because of that subjectivity around applying the effective age and the current effective life, it does limit your cost approach a bit, and so that's where you probably would want to have a secondary approach. If in fact you're doing this for more of a corporate perspective or from an owner user perspective under fair value. But I would give that approach a lot less weight under a market value perspective, and under an income producing property, I would probably give that very little weight. So it depends on the scope of what you're doing.
Thank you, Jim. Yeah. I mean, now that you say it, yeah, heritage assets and listed assets come to mind. Yeah. But once again, estimating an effective yield is really tricky if the asset has basically gone past what would be deemed as economic useful life. Yeah. Question from Basim: what is the source of external obsolescence? I think that goes back to the example, the illustrative example you gave earlier on, where different types of obsolescence.
I'm sorry, Paco, again, the source for what obsolescence?
Yeah, what is the source for external obsolescence, or what causes external obsolescence? Or what would be external obsolescence?
You kind of got muddled there, Paco. I don't quite understand. Perhaps you can maybe send me the question or type it out for me.
Right. Literally, like reading down literally, it says, what is the source for external obsolescence?
What obsolescence?
The source. So I'm just trying to figure out if the question
Yeah.
is asking what is the cause versus what is the source. All right. So literally it says what's the source for external obsolescence. If it's not clear, I can move on to the next question.
Oh,
And
okay. I think the source for external obsolescence. I think it's external obsolescence.
Yeah.
If I heard that correctly, I think maybe if I've interpreted it correctly, I think it's external obsolescence is a question. The source, external obsolescence, the source it's a calculation, right? And in its comparison. So there's different ways of doing it. The way that I showed it is a fairly simplistic methodology where you have your cost approach, you haven't assumed any external obsolescence, yet then you do your other approaches and you're coming up with a vastly different number under a market approach and under an income approach. And that residual number is what I think of the external obsolescence. Another way to look at it would be, it's more from an income perspective, is what income is necessary to be generated to support a new construction. And if you look in that market, and so say, for example, if you require, 50 real, but the market is only supporting 45 real, then in theory, that five real difference would be the implied external obsolescence, if you present value that some form of, or capitalize that in some form or fashion. When you capitalize it, you're saying it's permanent, so you never know how permanent it might be, but you got to be careful with that. But that's another way to look at it. Just look at the differential between what rent or what revenue is required to be generated to support the replacement of this property versus what in actuality the rent in the marketplace is that day, or what buildings are selling for at that point in time. Those are kind of different ways to compare also. So there's no, again, it takes a little bit of thought around these things. There's nothing that you can look at, perhaps, online, other folks and how they've established that. But we try to keep it as simple as we can and look at the differential around what's driving it, and those are the kind of ways that I've dealt with it over the years.
Thank you, Jim. Thank you. One more question. When calculating the cost of replacements, so basically calculating the replacement cost for buildings, in the case of fair value, can we use the standard life the depreciation? So same question that was asked earlier on, but being asked by a different participant in a different way. So my guess is the answer that we gave earlier on in and around the standard life holds true. So unless you want to address it, I guess.
No, I can repeat the question one more time, Paco, for me.
Sure. Question says, when calculating the cost of replacement for buildings, in the case of using fair value, can we use the standard life to calculate the depreciation?
Yeah, you can. You said not extended life. You said standard life, right? Standard life.
Not standard life, right? It's literally obviously it's extended, so not standard life, not standard building life. That's standard life, yeah. But possibly that's a mistranslation, yeah.
Yeah. So Paco, what I would say is, and again, I hope I'm answering the question, and if not, then we can take it offline, and we can maybe revise or look at it in more detail and give you a better answer to this. But ultimately, the life used, again, as I'm thinking as the denominator, which is the overall effective economic age. It may be again, I think maybe the extended life, that becomes a valuer opinion, and it's normally like I rely on these various different cost manuals, looking at the life that's assumed around these structures from an economic perspective. Now, again, there's physical lives and there's economic lives, and I say economic lives are valuation lives, right? there's subjectivity around that, and I would look at in terms of where you're located, what the history is around it, and if you can identify outside of for example, I've done work in stadiums and arenas. Also done work in again, I think I mentioned before, fab facilities, and there's enough information out there to show that their lives are much less, economic lives are much less than what would be put in cost manuals. Excuse me. So I use cost manuals as an initial basis, but if I'm able to establish based on market information, the economic life of a stadium, is 30 years, or of a fab facility is 20 years. I use that as my denominator. And so to the extent there's market support around that, you can use, whatever you think is appropriate given the asset type. When it comes to manuals, they have suggested years, but oftentimes, those numbers, can vary depending on the use. And then lastly, but I didn't mention this, is that many companies have depreciation policies. And by that, I mean, they often use much more aggressive lives to do their amortization on their books. Now so what I try to clarify for clients is, look, when I show the remaining useful life of, in the example I gave was 26 years in the building, they may have a policy where they amortize their buildings in 20 years or 30, or 30 years. I mean, it can vary. And so I just tell them, look, my lives that I'm estimating are valuation lives. But if they have an accounting policy, that carries the day for companies, and they can use whatever they want to use from an amortization perspective. But from a valuation perspective, I try to use what's best available from the market information.
Thank you, Jim. Question from Shoaib Sharif. It's a short question, but it's quite loaded. Based on the example you presented, does it mean that the income and sales comparison approach are not preferable in determining the fair value? I think what he's trying to say, or what Shoaib is trying to say, is, are we saying the cost approach is more preferable than the income and the sales comparison approach when determining?
And I would say that my answer to that would be no. I to the extent you have enough, but the reason I show it this way that I did is that there are a lot of unique situations with corporates that, frankly, they wouldn't necessarily build. They wouldn't necessarily build, or let's put it this way: they would build the same building, but it's in a location or an area that doesn't support it from a cost perspective. But that cost is justifiable to the company. So in those cases, the cost approach is preferable, where you're seeing a construction being done on a facility at such a level that it supports their business, but it does not translate necessarily to the marketplace. And again, I think of the fabrication area and or in data centers areas sometimes, where you may see things trade at, or not trade, but be built at billions and billions of real, versus the market might support. If somebody were to come in and buy that from them and they exited, it might be half of that, because what the market would support. So I think it all depends on what the situation would be. But I encourage you look at all three approaches, and again, where you've got a gap, that suggests to me that there's an obsolescence factor here that again may not apply for your valuation exercise. But if there's such a gap, then those approaches wouldn't be reliable for the fair value approach, and I would rely on the cost approach methodology. So, but I've had many situations in very transparent markets where the cost approach or the market and income approach actually suggests values above the cost approach, and we use those approaches over the cost approach to get to our fair value in those assets. So again, it depends on the marketplace you're in, but I would not discount any of the approaches. I think you have to go in assuming you're going to use all three, but ultimately you need to rely on the approach that you can get the best information on, the best data on.
Very good answer, Jim. So Shoaib, just to elaborate on that a bit, Jim gave that example of say data centers, right? You look at a typical data center, it's vast. They build in a lot of redundancies, right? So everything has a backup and the backup has a backup to ensure that nothing fails. That wouldn't be a typical market value type scenario. But in terms of a value in use, it's value to the business. All that stuff that they put in there is essential. So in terms of looking at it from a cost approach standpoint, you capture all this and all the additional stuff that's been done to it. Jim gave an example of clean rooms, say in pharmaceutical or fab spaces, where what you need to put in terms of clean room spaces, especially the higher rated clean room spaces, you require interstitial spaces where once you begin to count all those services that are put in there to keep the space clean, the cost approach will capture all that and result in a value that's over and above what looking at it as a market approach or a glorified warehouse or shed would result in. So that begins to bring out some of the difference between value in use, fair value, especially for specialized assets, versus looking at it as a market value to general market participants. Another reason why you'd be using that cost approach is it helps when, as part of your reporting mandates, you need to report remaining useful lives, etc. It's an approach that lends itself readily to making those adjustments and reporting those numbers. But use all the approaches wherever you can. Each approach serves as a cross-check to the other one. And in most cases, fair value, market value, you will be arriving at the same value conclusion, more or less. Yeah. Apart from the examples and some of the suggestions that we just gave in this answer, right? Thanks. Shoaib, you have a follow-on question. He said, how can we get the fair value of vacant land if income and market approach are not preferable? I think Jim's first answer captures or answers the second question, right? He never said not to use income and market approach. And even within the cost approach, the value of the underlying land, you resort to using a market approach because it's a comparable approach to get to the value of the land. So
yeah, Paco, I should clarify that, for land, you're right. I mean, the preferable approach is market approach, is comparable sales, and that's clearly for land that's preferable. In cases where the land, if there's government control, and there may be situations where again, they lease the land to companies and they set the price, they set the rental rates. You have to deal with that appropriately too, accordingly, where you can't necessarily find market sales. You have to look at it from more of an income side potentially. So again, I think that's a good point that was brought up, and I'm sorry to confuse everybody on that, but clearly for land, your market approach is preferable. Where you've got lease situations, a little bit different calculation, more of an income type of analysis. And then there are certain places where the land values get set again by the government. And so in those cases, we bring that in based on, that information. There's a less transparent market. It's more government controlled, and you have to rely on that input. Okay. So again, I just wanted to make sure that was clarified. So I apologize. That was a good point that was made.
Thanks, Jim, for the clarification. That really helps. And thanks, Shoaib, for those questions. Yeah, they were insightful questions. Moving on to a couple more questions. Bassem said, I forgot to ask his question. Bassem, I believe I asked you a question. If about the source, we did our best to answer it. If it's still not clear, please drop me an email or let's speak offline, and I'll get back to you with an answer on that question. Yeah. From Majid, the question is, how can we avoid or notice red flags in REITs valuations? And which financial ratio do we not ignore? Jim, I'm not too clear on the question. The red flags bit, I'm guessing that is just the best practice stuff and cross checks to make sure that you're doing your valuation properly. But in terms of which financial ratio not to ignore, I'm not too clear on the question, unless you read it differently.
Yeah, no. What I would say here, we're not. So REITs usually are and again, I don't know if he's referencing potentially, the price per share or things of that nature. if it's publicly traded, we don't, again, there's the public is determining that value per share. We do work for net asset value calculation, and in doing that, you do individual values of assets, and then add those up, and then deduct off liabilities and add other assets and other liabilities off to get down to a net asset value. The problem right now, and that question is in Paco, we're dealing with this right now within the TAB, listed versus unlisted properties. There's a huge spread between what REITs think their assets should be worth on a public basis or into the market, and what they're actually trading for. So from an accuracy perspective, I think you've got to look at how the company is doing their calculations and what their methods and sources are. But in terms of doing kind of the fine tuning, the back of the wall, the back of the envelope analysis, again, we do work with both public and private, not public REITs and private non-traded REITs, and along the way, there's always a valuation process that goes on. And again, the companies have to outsource that work at some level, and so that's how the check is being made, is by outsourcing that work to some degree. But if you're asked to take the information from the REIT and seeing if it's reasonable or not, I mean, you need to get behind the curtain a little bit and see how they did their calculation. They just give you numbers without any validation behind it. Let's go back to the old audit process, right? If you're having to audit their analysis, if they don't provide that level of detail, you really can't audit it, can you? So I think that I'm not sure if I asked the question or not, and I think we can, Paco, if we can get that question clarified, we can answer it offline. But again, I think right now we're seeing huge differentials between REITs and if you add up their asset values, what they think their REIT should be worth and what they're actually trading for.
Thank you, Jim. That's a really good answer. Yeah. That's a question. It's quite long. It starts off by giving thanks to you. Yeah. So thank you, Jim, for presenting this professional meeting. There's a question regarding the accounting treatment of development properties, which are sometimes different. For example, these properties are for the purpose of sale or lease by their owner, or they belong to investment real estate funds, which are REITs. And this may be affected by the valuation requirements. What are the appropriate valuation criteria?
Yeah, so that it's funny. I turned to the page here. It's a few pages later from the presentation. IVS 410 is development property, and so it's interesting. There's been questions as to why IVS is dealing with 410, but I think the question that came out really reflects a lot of concerns around development property. The challenge there, how we've dealt with clients on development. We do a lot of work right now. We're in the midst of it right now. Year end is pretty big in terms of reporting and financial reporting around current clients that are invested in various different properties. I think the development properties are also referenced being value added properties. If it's by value added, usually it's usually maybe an existing structure being modified, but for the most part, it's land development. And so the way we focus on it is we kind of take it in iterations, and what's good about it is potentially it could be a good source of long-term work because they may need to value it at different stages and different levels. But how I approach it is that going in, okay, what are we trying to report? Well, we really, from an investor perspective, they want to know what the as-is numbers are. They don't want companies to book on what their value might be once they've done the full development. They want to know what it is at certain stages. So you really have to look at where they're at in the development stage and ascribe value at that point in time as of that date. Now, it doesn't mean you can't provide a future value to the client to show where the value would be at that time if this were completed. But ultimately, what they're booking are values at stages, right, that are reflective of what's actually there. So, so you start in an undeveloped land stage. What are you valuing? Well, you're valuing the land. Now, the land may have certain densities and certain rights that allow you that provide some premium to the land value, but that should all be factored in based on zoning, based on the density allowances, things of that nature at that time. And then say 6 months, or say a year, 6 months later, they want you to revalue it again, and they've added, they've cleared the land, they've added a foundation, they've started a structure, they've spent dollars on construction. Normally, we look at that stage, and oftentimes we'll look at that as kind of it's kind of it's not even a half-built building. We'll probably give them their land value plus the cost they've spent to get the structure going. But then 6 months later, the structure is in a shell condition. You value it then as land plus a shell, and that can be done via cost approach, or being some kind of residual, looking at an income approach upon completion and taking it back down to a shell value. So there's iterations you go through along the way and steps you'd have to make. And so I think you need to clear with your client what data value are we assuming, what condition are we assuming, and once you understand that, then you can kind of take on the task of doing the valuation in the way that they're looking for. But nonetheless, I'm always an advocate for always providing an as-is value, the value of the property in its current condition, because as a valuer, that covers you on, okay, as of my current date, here's the value. But in future dates, here's what you'll have, and therefore the value at that point will be some higher number, hopefully. But having that as is value already stated covers you on you're dealing with the current point in time. So I don't know if that answers the question fully, but development property is certainly a challenge, but I think it's one that you've got to take an iteration. You got to take one step at a time and educate the client that look, I understand in the back end here you're going to be at some number up that's very high, hopefully high, but at the same time I've got to value it with what you currently have in place, and you can do some kind of hypothetical adjustments or conditions around that, but that becomes a discussion in your engagement letter and with the company as far as what you're providing in terms of a deliverable.
Thanks a lot, Jim. The questions are coming in hard and fast now, but I'm aware we don't have that much time. So what I'm going to do is, with the audience's permission, I'm going to hold all questions, let Jim finish the presentation, and if we do have some time, we'll take additional questions. Any questions which we are not able to take live during the session, we'll get back to you later on with answers. Yeah. So Jim, I'm over to you.
Yeah, and I can be quick on this, because I think a lot of this is some redundancy. I just wanted to close out by indicating or highlighting certain situations that I think some of the hypotheticals or some of the situations you've brought up are really relevant under these next items that I'm talking about here. So I just wanted to bring these to the fore. And I know some of this has been discussed in previous sessions that you've had, but again, I wanted to close out with kind of a final refresher on some of these key items that may trigger how you approach your valuations for financial reporting, for any valuations. But I wanted to highlight the in use versus the in exchange concept. Again, the differential as I see it is that the key under in use is that the maximum value to market participants, principally through its use in combination with other assets as a group, installed or otherwise configured for use. So really, that becomes more of a corporate perspective versus an investor or a REIT or something of that nature, which really more or less falls more under the in exchange concept here. So I just wanted to bend these definitions back in. I think you've seen them before, but just wanted to remind everybody, the differential, here and kind of how I keep it in my head, how I keep the separation of the two as much as possible. Under IFRS 5, again, that was covered in a previous session. This goes back to when corporations say they make an acquisition, there's some redundancy on locations. And so typically what happens if there's redundancy, certain locations will get then taken off the balance, not off the balance sheet, but they'll get taken and get recategorized as being held for sale and discontinued operations. What that immediately means is that it goes from a fair value to almost to a market value perspective, in my view, in terms of as a valuer. And so it means that a broader market it would be looking at this. And so the assumption of occupancy by the existing company is no longer there. You're looking at really kind of a vacated structure, and so the valuation around that is significantly different the value of the property with the current owner in use in the property. So this is IFRS 5, and it's pretty typical that we'll see this oftentimes with clients. They'll have an idea of this ahead of time, where they'll be engaged with a broker to give us this information. The key here is, if you look at it, you held for sale. You have to also deduct, by accounting rules, you have to deduct out the cost to sell. So its fair value is a number previous, less cost to sell, which is usually brokerage commission and anything else around that. And then any depreciation of that is not taken any further. But the key part here is the different step here is that you got to add a cost to sell after your fair value to get down to a net. I guess net realizable value is kind of how it's defined. But again, this is kind of a different step that we don't see often, but do see occasionally. IAS 16 is relates to property, plant, and equipment. I reference IVS 300, IVS 400, and IVS 410 as really key elements that deal with IAS, or that are supportive of IAS 16. IVS 300 is called plant and equipment, and actually at the end of January of 2024, the new IVS standards will be put out, and it'll be adding infrastructure. The determination was made by the Tangible Assets Board that we needed to address at some level in infrastructure. For now, we decided that the good place to put it, was under IVS 300. But keep in mind that a lot of us in the real estate side deal with roads and infrastructure, as far as roads, toll roads, stadium structures, bridges, things of that nature. That as real estate valuers, we can also handle this type of work. But we felt the best place to put it currently is under IVS 300, in referencing the infrastructure in IVS 300 via 400 and 410. 400 is still the real property interest, and 410 relates to development property. So what you're going to see is at the end of January some very modest adjustments that probably don't drive a whole lot of difference from what you've done. I think the infrastructure addition is probably the more important thing. You'll see also some additions regarding data inputs, valuation models, documentation and reporting, and then some ESG content. So I would encourage everybody at the end of January, when it's published, to take a look at these revisions. I don't think it's going to change anything that you've been doing, but I think what it'll just elicit the fact, the recognition that we're trying to recognize there are more challenges in the future years coming up in different types of segments that we need to be able to address. And then along the way, the goals of the Tangible Assets Board is going to be to expand discussion around, or I guess, whether it's putting together white papers or commentary around some of these items to discuss, a lot of what ifs and best practices around these types of issues going forward. That's kind of where Paco and I will be dealing with the next year or so. Last one is impairment. We talked about this already, I think, to some degree, that it's a step taken by companies if it really comes into play when the company is losing money or is running at negative cash flows. When that happens, then they're required to relook at their carrying values, and it first starts with the business enterprise. If they find the enterprise is losing money, then it goes to the tangible assets that need to be adjusted, that are on the books, and see where they are at relative to that, to get down to a fair value or an impairment charge around the value, to get down to a fair value of the company that's probably changed from the time it was initially valued. If in fact you do that analysis and there is no impairment, then you don't have to book anything. But usually this is driven or generated more from a business enterprise perspective, and we get involved on a real estate side if they have real estate holdings, and where, if you add the current book value of the buildings and the real property and the personal property, you add that up, and it's worth more than the business enterprise. then obviously you can't be carrying these assets at those values because the business won't support it. So you've got to go back and relook at it. And that gets then more to more of a market value and exchange approach. And in that case, that market value and exchange, excuse me, even though it's market value, or even though it's market value and exchange or value and exchange, market value is equivalent at that point to fair value. So that's where you kind of the merging comes in terms of fair value and market value when we have this kind of situation. Oftentimes, they're one and the same. I think with that, Paco, I think that leaves it. I just wanted to again highlight those going out, but open to look at the time here. Open to a few more. I guess we're at 2 hours, but I'll leave it to you. Happy to stand for a few more minutes, or we can disband and I can deal with questions offline.
Okay, cool. Thanks a lot, Jim, for an insightful presentation. I'm going to fill 2 more questions, which we can answer quickly, because one of them ties into what you were just talking about in and around fair value and exchange and market value, right? So this is a question from Mahmoud Taha, where I'm going to read it verbatim, and we can take it from there. Where his question is, he says he understands that the value of the property varies according to the purpose and the restrictions on the property. So his question is about fair value and market value. Is it true that there's no difference in the results if we take the same assumptions?
I mean, logically, yeah. I mean, there wouldn't be a difference. I think, yeah. Again, the distinction would be there's a different level of concern depending on who you're valuing it for, right? And so, I mean, again, I'm just thinking rationally. All things being the same, you would think everything being the same, there'd be no difference. And again, I get back to the example I just gave, where you've got a fairly transparent market in terms of income and income data and sales data, market data, and then you've got a number that or a company's been carrying a value that was predicated on a cost approach done several years ago, and now the company is no longer making money; they're losing money. The combination of net book value between the real and personal property exceeds that of the business enterprise, then you would run with the same assumptions, and that market value you determine, or that value you determine, would be, in my view, equivalent. Fair value would be equivalent to market value in that situation. So in that case, you have the same level of similar assumptions. I think the example I gave between fair value and market value difference was that we were assuming, again, one level owner, the cost to build exceeded that what a traditional return would be to improvements in that particular market, and therefore the assumptions would be different. So yeah, I think to answer that question, that to me, again, one side versus the other, everything is the same. You would think that the answer should be the same.
Thank you, Jim. A good answer to a tricky question. All right, yeah. So one last question. This relates to restrictions. So basically the question is, what restrictions or caveats would you recommend using in valuation reports to avoid committing violations? It's a very broad brush question.
Yeah.
Just best practice in and around caveats and limitations.
Yeah. I think the first thing, use your instinct. If you're not comfortable with something, then you want to, if something makes you uncomfortable, then you want to point it out. And so that'd be my first recommendation. You're gonna get a feel for something, and if you don't feel good about it or don't feel comfortable with it, then you want to call that out immediately. As far as restrictions, again, if they don't provide you, for example, I'm just thinking out loud here, they want you to provide you a value, but they provide you a fixed asset record, but the fixed asset record is 2 years old. The building was built 20 years ago and is been fully amortized, but they don't necessarily provide you with any updated information on what they've spent in the interim or that type of thing. It's an income producing property. They're not providing you with operating history or operating information. They're providing you with just a rent. They're not providing you with access to a lease agreement or an abstract that describes a lease. All those types of things would be issues that I would be concerned about, and I put limitations on my analysis. We can all come to evaluation at some point based on a certain set of assumptions and a certain set of information. But the less there is provided to you, you need to call it out. And I think it's operational information. It's historic or it's cost information that they should have access to. It's a contact. It's a site contact. If you're going to go on site, it's someone to take a tour with you that understands the facility or understands the asset. All those types of things you want to reference as being limitations to your analysis along the way. And then at the end, if you're running your numbers and you just aren't getting, you're getting this variance, and it's not uncommon to get this huge variance. You have different approaches and this huge variance. Then you've got to have a conversation probably with your managing, your leaders within your organization or with the client and talk it through and say, here's what we're coming up with, but there's, how do you bridge that gap? There may be reasons you're not bridging it because of lack of information. And so, again, to Paco's point, it's a pretty loaded question, and there's a lot you would cover in there. But I just go back to, what do I feel comfortable? Can I sit here and talk to you and be comfortable with my result? And if not, then should I be doing it at all? Or if I can be, here's what I can be with these limitations. That's kind of how I would think about it.
Thank you very much, Jim. And thank you for an insightful session and for your invaluable contributions to Taqeem's CPE series. It's been really helpful and it's been really useful. Thank you, audience, for some really interesting questions. I didn't realize we're going to have so many questions. We may have planned for a longer webinar. So we may have a follow-up to this webinar. And in terms of the rest of the questions, just reach out directly through Taqeem's communication channels, and we'll look to answer as many of them as possible, or drop me an email, and we can do that.
Paco, if I could thank Taqeem for the opportunity. I really appreciate the chance to talk. I know this is a tough, broad subject, and so I do appreciate the chance, and I appreciate the patience with explanations and preparation around this. And again, the late hour, I understand. I know it's a late hour for everybody there, so staying on this late, it's much appreciated. And hopefully I've helped somewhat. And to Paco's point, to the extent there are additional questions that we can kind of respond to, I'm happy to do it over the course of the next few weeks, if necessary.
Thank you, Jim. Thank you so much, and thank you, audience. Bye-bye, and assalamu alaikum once again. Have a good night, and a good morning to you again, Jim.
Great, thank you. Yep.